The last two sessions, we covered sort of the liquidity, solvency, profitability, and activity ratios. And I think I ended off at the long-term activity ratios, where we take your sales and you just divide it by the total assets or the fixed assets, depending on which financial ratio you wanted to look at. But just to highlight, I want to take this last session just to highlight sort of what other ratios you could also see pop up that I didn't cover in detail in the first two parts of the videos. The first ratio is one of the short-term activity ratios, which is working capital turnover. So yes, we had calculated in the short-term activity ratios, we had already calculated, if you remember on the right, inventory, receivables, and payables turnover. So what we didn't do in that section is calculate what is called your working capital. So just to clarify what working capital is, when you're looking at working capital, you will then take your inventory, because that will be form part of your working capital balance. You add your accounts receivable, and you then need to subtract. So you're funding your inventory balance, you're funding your accounts receivable balance to allow people to take stuff on credit. But then our suppliers are funding us, so we're going to subtract our accounts payable. Okay, so we'd already in this inventory calculation above had calculated what the turnover is for each of these. And what I'm going to do now is just take the denominator balance, because that will then give me my working capital. So I'm taking what this is, which is my inventory balance. Okay, I've divided it by 2 to get the average. Okay, I want to now take my receivables denominator balance, also divided it by 2. I add it to my inventory balance, plus my accounts receivable. Okay, I've just added the two average balances together. Okay, and lastly, I can now subtract what my payables balance is. Just copying the denominator again, then I'm just subtracting the payables balance. Okay, so if you notice, my working capital will now be negative, which makes sense because what you're doing is you're taking the average days, you're adding these 2 days, which will get to 70, and if I less my payables days, which is 74, will give me to a negative working capital days. So this will then be my working capital average balance. Okay, all you're doing is taking each of the inventory balance, receivables balance, and subtracting the payables balance to get you what is called the working capital. And then I can also calculate a working capital days, and my working capital days is also doing the same thing, but you're now taking each of the days instead of the balances. And your days is just your inventory days plus your receivable days less your payables days. My working capital days are also negative by 3.7. This is a good sign. It basically means your suppliers are funding you, but you're able to collect your receivables a lot quicker, and you're able to pass through your inventory and your balance a lot faster in your business. And we always want to be in a negative working capital balance. A lot of retailers, even Pick and Pay, that are successful, are able to actually take longer to pay off their accounts payable and longer to pay off their suppliers, but they collect very quickly and their inventory flows through their balance very quickly, which ultimately means they're sitting with a negative working capital balance, which means the suppliers ultimately are funding a lot of their business operations. Okay, good benefit of your working capital, which also translates into a benefit on your cash flow. Okay, then the last ratio I wanted to touch on, which I always highlight in a lot of the sessions that I cover when I cover financial ratios, is your DuPont analysis. Okay, DuPont analysis basically takes your return on equity And what is return on equity made up of? It's your net profit after tax. So after tax. So it's your net income or net profit after tax. And then you divide that by total equity. We can split up this ratio into 3 different parts. Okay, and the 3 different parts can cover different aspects of the ratios that we had already covered. We can cover profitability, we can cover activity, but the long-term activity, and we can cover solvency. If you look here at the ratio on the left or the right, I've tried to replicate what we're looking at. The net profit margin, which is a profitability ratio, is net income divided by sales. Your total assets turnover, which is a long-term activity ratio, is sales divided by the total assets. If your sales and your sales cancel out together, so if you see here on the right, I've indicated them with colors, you're left with profit after tax divided by total assets. You're left with return on assets. Remember, return on assets was your profit after tax divided by total assets. But then if I then include also my solvency or my gearing, an indication of gearing, and I put in the equity multiplier, my equity multiplier, remember, is total assets divided by shareholders' equity. If I cancel out the total assets together with the total assets, I'm then left with that profit after tax divided by total equity. So whether I calculate a return on equity as either net profit after tax, or I multiply my profitability, my long-term activity ratio of total asset turnover, and my equity multiplier, I should be able to get to the exact answer looking at those 3 ratios multiplied by each other, or by looking at the return on equity just by doing the same simple calculation of net profit after tax divided by total equity. So similarly, if I look at here, my ratios that I came up with for ShopRite, my return on equity, if you calculate it just by the profit after tax divided by the total equity balance of 19,555, I got to a return on equity as a percentage term. I got to a return on equity of 11.41. I just want to get it in decimal places. Okay, and then I should get to the exact same answer if I were to look at these 3 aspects of my ratios. Okay, my net profit margin, I can take that from my profitability calculation, so it was above. My net profit margin under profitability was 2.67%. Okay, I bring that to the bottom. My total assets, total sales divided by total assets, which is my long-term activity, is just here above. Can take that percentage. And then lastly is my equity multiplier. My equity multiplier, I just move this. My equity multiplier is under your solvency ratios. So under your solvency, I take just the equity multiplier for the 2020 year. I get 4.29. If I multiply all those 3, excuse the sign. If I multiply all those 3, I should get back to your return on equity of 11.41. Let's see, exactly the same, 11.41%. Okay, so a nice way to discuss the return on equity, I can say to you in a calculation, please, what are the main drivers of the return on equity? If I say main drivers, you know, the return on equity is the drivers are 3 aspects. It's either your gearing that is pushing up your return on equity, or it's your net profit margin, which is significantly higher, or it's your total asset turnover, you actually using your assets efficiently. If you look at the instance of ShopRite here, 2% for their net profit margin, let's say maybe versus an industry or just a normal JSE average of, let's say, hypothetically speaking, I say normal companies are able to get net profit margins maybe of 6%, 2% for a retailer, maybe a little bit small, but how are they able to then get that return on equity to be higher? They are able to then use a lot of significant gearing on their balance sheet. So 4.3 of gearing, that amplifies the return on equity return. Remember, we multiply all these 3 together, and maybe the activity is maybe the general norm. But either way, you need to be able to disaggregate this return on equity of 11.4% and see, okay, based on this company itself, I can give you maybe an industry average, maybe an industry average here is maybe 3, and here it's maybe 1, and maybe here it's 3. Then if we're comparing to the industry average here of 3%, 2.67%, their net profit margin maybe is significantly lower than the average. Their one is also in terms of the asset turnover, they're not as efficient in terms of total assets, but they are using significantly higher gearing and higher risk. So that's how they're able to maybe amplify their return on equity, and maybe their return on equity is sitting above the industry average. Okay, very interesting ratio to look at, and very interesting topic of analysis, especially between industries, to see where do the industries make up their return on equity. Is it maybe from leverage? Is it maybe from the actual profitability? And then you can actually discuss this in depth when looking at this ratio. All right, that's it on the financial ratios. We had to divide each of the sections into 3 sessions, given this DuPont analysis and this importance of this topic. But yeah, hope you guys went go through it. Thanks. Cheers.